we think it's 2 to 3 years away before that really starts to happen. And that's the story, right? Because that means there's a real sweet spot in there for investors to take advantage of before that major change happens in a fundamental trend, the interest rates.
Hello, everybody. It's Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, chef, father, six, best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I'm doing good today, bro. How you doing?
Always making it happen, big man. Today's guest is Brian Beaulieu. Brian has served as CEO and chief economist of ITR Economics since 1987, where he researches the use of business cycle analysis and economic forecasting as tools for improving profitability. You think multifamily owners can use some of this data? I think so. As a speaker and consultant, Brian has also provided valuable and practical advice to companies in need of domestic and global perspectives to increase profits through business cycle trend analysis, forecasting, and effective planning. So without further ado, Brian, welcome to the show.
Thank you very much. And boy, I sound very boring compared to you guys with that introduction, business cycle analysis for corporate profitability, but it is what it is.
That's okay.
We always say education times action equals results. So we'll bring a little bit of the action today. You bring the education and we'll have a great marriage.
Okay, sounds fair.
So let's get to know each other a little bit. Tell us a little bit about your backstory and your business career.
The backstory is you started way back when, started off life thinking I wanted to become an accountant. And this professor was giving me a hard time because I wouldn't find out why I wouldn't balance $5.02 on this trial balance. I said, this is stupid. I'll give you the $5.02. He goes, no, I don't think this accounting thing is for you, Brian. So, maybe you want to go where close enough is good enough, like economics. Why don't you try that out? So I liked it. It was a little bit more dynamic, a little bit more changing, and it's been a good ride for 40 years. So it's good.
Brian, it's funny you say that because my son is a freshman in college and he's doing accounting right now. He's taking an accounting course and he's doing depreciation, amortization schedules and all. And it's painful. And I'm glad he's doing it. And I'm like, you know what? You're not going to be an accountant, but you at least need to understand what the hell you're reading, right? So that's the important part. Brian, what do you love about economics that you've been doing it since 1987?
It constantly changes. I mean, even without the COVID thing, it is. There's always so many different variables. At ITR Economics, our whole approach is the economy is like a symphony, right? And there's so many different aspects to the orchestra that sometimes you get a little bit more forte out of one part of the orchestra, sometimes you get another out of the other, but it's a beautiful piece when it all comes together. In fact, we don't hire anybody for an economic position who isn't a musician, because that's how much we believe that, it all comes together and you can't focus on just one thing or else you're going to miss the bigger picture. So it's been fun.
What is the bigger picture right now? Do you see that's going on in the economy? What are you looking at? Because there's so many different moving parts. Housing is crushing it. I'm in some cryptocurrency. Cryptocurrency is crushing it. Stocks are crushing it, but the underlying economy is doing terribly. So what are you seeing in that big picture right now?
Oh, why do you say the underlying economy is doing terrible? Because GDP bounced back in the third quarter. Although we're still below pre-COVID levels. Retail sales are running above comparable 2019 levels. So the consumer is back. The consumer has been given a boatload of money to spend. We have savings about $1.5 trillion above year ago, normal levels, rather, not year ago, but normal levels. I don't see where it's terrible. Unemployment's down to 6.6% from over 14%. I mean, this economy it has so much energy and so much stimulus within it that when we get this COVID thing resolved, we're not only going to make recovery progress, you're going to be amazed at how fast this economy of ours is going to really accelerate in its growth. And we have it rising all the way through 2023 and maybe beyond.
So, Brian, aren't you afraid though of all the money that's being printed? I mean, that's the one thing that fears me. When you listen to the news, you think it's all doom and gloom, and I sometimes subscribe to that. And I'm afraid of all the money that they're printing and all the stimulus that they're creating, and it seems artificial to me. So, do you have any thoughts on that?
Yeah, I try not to be afraid of those things. It's usually people that scare me more than money. But
People are the scariest thing on the planet. I will give you that.
we've looked at, for instance, some folks are talking about the fiscal stimulus, and that concerns them, and that really is tied to the size of the debt, right? And that's a separate issue. When you talk about money, you're talking about the monetary stimulus. That's the Federal Reserve's gig. And the sheer magnitude of what they created out of thin air, the fiat currency, is what has a lot of people stoked or worried about the future, right? We've done that. We've done the analysis on that because this isn't the first rodeo. It's just a much bigger rodeo. It takes time for that stimulus, all that fiat currency, to actually start turning into inflation. And I meant churning, not just turning. It is a churn and burn type thing. And in fact, that's what's driving the stock market right now. But think about it. We're still well below capacity utilization levels worldwide. We're still dealing with the demographic, that population that is not the utmost confidence right now, and they are somewhat limited in their interactions. So without those interactions, you're not going to get a whole lot of economic activity going, right? So it's all going to take time. We see that it'll take 2 to 3 years before all this fiat currency starts creating some of the inflation that people are worried about. But even at that, we're not as concerned as a lot of other folks because of the age of our population. You know, people like me, our age, we don't spend as much as we would if we were in our 30s or 40s or even our early 50s. And we are aging. And that puts a lid on how much inflation you might see out of this. We think there's some inflation out there. We think there's enough that's going to be driving interest rates up, but we think it's 2 to 3 years away before that really starts to happen. And that's the story, right? Because that means there's a real sweet spot in there for investors to take advantage of before that major change happens in a fundamental trend, the interest rates.
So what asset classes are you bullish on right now?
That was my exact question, Gino. Yeah, hold on. Before I want to hold on this point for a second, because he brought up a very interesting thing, and this is exactly where my mind went. There's a 2 to 3 year window before the inflation hits. So if you can buy assets at the current price levels, multifamily, such as we do, you think there's an opportunity if the price hasn't already been fixed in for the future inflation. Is that what I'm hearing you saying?
Oh, absolutely. That's exactly what I'm saying. And if I said something interesting, by the way, you just made my day, because I'm an economist. I don't often say anything interesting. So
I'm sitting on the edge of my seat here because this is what we do. This is
music to our ears. This is the most interesting conversation we've had in a while. So,
yeah. In fact, real estate is always local, right? And right now we're talking a macro trend. We can get more state specific if you want, but from a macro perspective, there is angst in the multifamily space because of vacancy numbers being high, because evictions could be going up. And when I look at it, I'm in no hurry to buy a piece of multifamily real estate that isn't already looking just right, because I think there's some softness in this space over the next 6 months. But sure as shooting, I don't want to wait longer than 6 months. I can't time the bottom. I don't think anybody can. You just try and get near the bottom, right? So I think in 6 months, we may be a little bit after the bottom, we may be a little bit before the bottom, but we're going to be close enough to the bottom of the national trend anyways, that you're about to capture something that's going to be going on for the rest of this decade on the upside. Not linearly, it never is, right? But in terms of a positive cash flow, in terms of capital appreciation, give me 6 months, and I think you should be grossly over allocating into this space.
Yeah. So here's the really interesting thing. So second time I'm saying that you're saying interesting things. You're in line with Fannie and Freddie because what you're seeing here is San Francisco, New York, Washington. Those are the areas, the big metros that are struggling right now with occupancy issues. What the agencies are doing, Fannie and Freddie Mac, they are pricing their deals differently, meaning that if you want to get a deal right now, they're probably going to hit you with maybe 65% loan to value, maybe 70% loan to value. So they're insulating themselves. They're looking for specific occupancy metrics that they weren't prior to this. In addition to that, they're asking for reserves that they didn't have before either. So they're still in the game, but they're taking precaution due to the occupancy issues. So you're seeing it from the big boys, and then you're seeing these kind of certain metros that are struggling with the occupancy. So that's the real concern. But it is local. Like I'm in Knoxville, Tennessee right now. We do not have a oversupply issue, and occupancy is through the roof. So you're seeing, obviously, you want to build. It's supply and demand. You want to build where the people and the jobs are. So that's why these metros have been built out. When COVID hits, people don't necessarily want to be there. So you see a little bit of a flee, and therefore it's a potentially short-term suffering. I don't know how long it lasts, but
well, it lasts at least a couple of years, we think, and it's not just COVID related. The three areas you mentioned, I'm not interested in those areas at all. But Knoxville, Tennessee, let me tell you about Tennessee, okay? Because COVID
it's got my heart and soul.
COVID is impacting states generally in a negative way. But so I went in and we looked at the state landscape in terms of their finances and how well they're going to be able to weather this storm and future storms. And when I looked at the debt to GSP, gross state product ratio, the state debt to GSP ratio, it was favorable for Tennessee. When I looked at how well funded the liabilities are in Tennessee, it also got another gold star. It was one of 4 states that got 2 gold stars. So it's one of my go-to safe havens right now in terms of investments and in terms of being optimistic about where that state's
no state
go.
income tax, beautiful weather, and we've consistently been below 2,500 active cases for the corona. So it's been low. We've been living our lives. People are going out to eat. People are having fun. Maybe I don't even want to say this. Maybe we want to keep it. We don't want the population to surge too much. Okay, but loving life here in Knoxville, Tennessee.
So Brian, let me ask you a question though. As far as those other states and cities you mentioned, how does a city like New York get back? It will eventually get back, but what needs to happen? Are they going to get bailed out? Because right now I have a lot of family in New York, and I have people secretly who are lifers in New York saying, I want to move now. And I've never heard that before in my entire life. I did it 3 years ago. I took the plunge because of Mr. Stenziano over there who did it 10 years ago. I couldn't take the state income tax. I couldn't take property taxes anymore in New York. I couldn't take the weather. And as you age, the weather's a factor and all those others are factors. And then when you have the governor saying, please, millionaires, come back. I'll buy you lunch. I'll buy you dinner. That doesn't bode very well. So how do you see these states coming back? I mean, California's back on lockdown from 10 p.m. to 5 a.m.
Are they socially distancing those lunches? Are they 6 feet apart for lunch?
I don't. And like by the way, he's getting an Emmy for what he's doing up there for TV. So like, how do these states come back? How do you see that happening going forward?
I'm not sure that you're going to see it happening anytime that in a time span that we would appreciate. Here's my thinking on that. Okay. COVID didn't create any trends that I'm aware of outside of, the number of deaths from COVID. But from an economic perspective, what COVID did was it accelerated some trends that were already in place. Okay. So New York was already not the best place to be investing money for all the reasons you just mentioned and the negative demographic. People were already leaving that state. California was already seeing, it had one of the highest outbound migrations and it had a below average population growth, and mainly that was lower social economic factors, right? Why would you want to invest there in the first place, right? Illinois, grossly negative in terms of its population and horrendous finances, bad tax situation. What's ever going to make those places come back? We may see that the bleeding is slowing from hemorrhaging, but I can't foresee a time that I care about anyways in terms of an investment horizon where I can anticipate that there's going to be an out and out reversal in those markets.
Unless they change their policies and unless they change governments, and that probably will not happen, correct?
That's the caveat, right? And personally, I don't have much faith in politicians. So, and I'm from Missouri in that regard. They better show me that they really changed their stripes.
Let me ask you, you're saying COVID has accelerated a lot of stuff. What has it done to the job market? basically. I mean, in a lot of sense, in your opinion, do you think we're going to go to remote, or is that just a fad right now, or is that going to be a part of the future?
Oh, the distributed workforce, is that the
Yes.
question, Gino? We were going there anyways.
Mhm.
That was a well-established trend. That was another trend that was accelerated by COVID, and it's here to stay, although we're seeing the impetus ebb already, but that trend is still going to be there. Obviously, there are swaths of our economy that can't do that, manufacturing or assembly work, and some cultures just won't allow that in their places of business.
Mhm.
But it's alive and well, and it will change the urbanization phenomena. I used to tell people, look, if you're going to invest in real estate, go urban.
Mhm.
Get something with a view, get something near water. Those are the three things that, and you hit two out of those three things, you're going to win.
Mhm.
Now with COVID, I've taken urban right off the table because that has really changed that dynamic. Unless it is, depends on how you define urban, right? But I'm talking about the extremely large MSAs. I'm not interested anymore. The smaller MSAs, then they still make all the sense in the world. Even amongst the large ones, there's exceptions, like Dallas. Give me anything in the Dallas area, and I'm excited. They're going to come back from this exceedingly strong. Texas has a well-diversified economy. The tax base, the tax structure is very favorable. Why go to California when you can go to Texas is my position.
Austin is the new California, right?
There you go. I mean, the population growth in Austin is just mind-blowing right now.
But the thing that frustrates me about that is they leave those policies and they come to the new state and they bring those policies with them. That's what I don't understand. That a lot of these states may start changing over. Same thing happened with Florida. Florida, I think, is a diverse economy. I think I live in the north of Florida, so it's a very more conservative, and then the south of Florida. And I see people moving here and they're coming from New York and elsewhere, and they're just changing to bring their policies with them. I'm saying to myself, we have no state income tax. We have a lower quality and cost of living and a better quality of living. Why are you bringing that with you? So I'm hoping that people tend to see that and go, okay, hold on a second. I moved here because of this. Let me try to change my policy.
Yeah, I applaud your optimism, but these are the same people who moved to Arizona to escape allergies, who then put in lawns and trees in their yards. Really, guys? What are we thinking about here? Florida is really interesting. I'm sure you've noticed, Gino, on the east coast of Florida, where you are, that's the eastern seaboard of the country, just sort of moved down there. They got on 95 and they didn't sway or stray off 95. Where I am on the West Coast, it's Midwesterners, totally different culture.
Yes.
Totally different vibe, because they came down 75 and never got off Route 75. And then there's Alligator Alley that connects the two, but that scared the daylights out of them back in the day, so they don't go there.
So talking about Florida, let's just jump into Orlando. What do you see Orlando? You think it's going to bounce back with tourism and all? Because right now they're taking a short-term hit, but there's so much building going on I-4. And Orlando is it's not just Disney anymore. It's expanding. They have so many different companies out there. What do you think about that city? Because you said worry about metros, that you don't like the big metros, but I think that may be one of the outliers that may buck the trend.
Yeah, that's a very good observation. Yeah, it is. When you look at our discretionary income, how we choose to spend it, what those trends are, you look at the sheer number of young families that are going to be out there in the future. It says an awful lot about Orlando. Our overall view is that clearly in 2022, the vaccine should be widely disseminated. In fact, I just saw that there could be 30 billion vaccines available by then, which would be a wonderful thing. Oversupply. So that means by 2023, the travel tourism business is probably fully recovered, right? Maybe even into some new growth as we cruise through the second half of 2023, which means the upside for Orlando, given the demographics and what we just said, remains positive. I am just not in a hurry to buy there, but if I own something there, I'd just be sitting on it and waiting for it to get back on track.
Love that. We talked about multifamily and we didn't get into any other asset classes. What other asset classes are you bullish on?
Within the real estate sector, Gino, or
just in general, as far as currencies, as far as commodities, and any other sectors, cryptocurrencies, any other sectors that you're bullish on?
I don't consider cryptocurrency an asset class. I consider that a speculative play.
I agree with
to
you.
Me, an asset class is
yes.
something that.
Brian, he had a little run up with some stock, and I'm saying, take your money and run. You're gambling right now, but what do I know? So I don't know.
That's all right. People's biases. What else? You can't ignore the stock market right now. It is being driven by the sheer amount of liquidity created by the Federal Reserve and the rest of the central bankers around the world. And that probably has another year, maybe even 2 years to go before that price has to be paid. So can't ignore that. But at the same time, I'm always, and this is true of ITR, we think real estate continues to be one of your best stores of value, particularly given the inflation outlook we have. Real estate's a great play against that future inflation. And never lose sight of the fact that the United States alone, amongst the industrialized nations, has a growing demographic. We're going to continue to grow as a population for the next 80 years, right? I mean, that's hugely important in terms of your investment. But I think you were asking more about the short term. Once the stock market gets nearer its eventual peak, we're encouraging people to make moves into some alternative allocations like commodities. And there it's really a dealer's choice. Do you like gold? Do you like silver? Those sorts of things.
What price do you like gold right now?
What price do I like gold right now? Nothing. I'm not interested in buying gold right now. I think it's a little early to
it's too early
gold.
for the gold. You think it's going to dip a little bit?
Yeah, I do.
Okay.
I think it's anticipating some things that aren't really going to come true. Gold is one of those emotive metals that they don't attract me all that much. I'm tells you about me. Copper, I understand copper. Copper is an industrial precious metal, right?
Yes.
And I can figure out what's going on with the Chinese economy and the global economy. So I'd rather make copper plays than gold
silver?
plays. Silver moves like gold, except it's more boring on the upside and a little bit more volatile on a day-to-day basis. So
it's like an economist, huh? Is that what you're saying?
Oh, Gino, and I've been so nice though. No, you're a little angry about that cryptocurrency.
Silver has a little bit of the copper to it because it's it's used in devices and things. So I'm thinking, well, maybe silver's the play here. Give me a little silver.
Why not? It can be anything you want it to be, really. I also think though, and this is strange for most people, we're coming into a good time to be investing in art again. That waxes and wanes too. And I think art, there are times when that's a very good play. And I think we're coming into one of those times. Look at what did well from 2000 through 2009, because that was a difficult period for the stock market. It went down and it took forever to come back. That's going to be how you see how the alternative asset classes can perform well in general after about a year from now, okay? I wouldn't go into the office real estate, obviously, and other classes that did well during that period, but be smart about the trends today, but that'll be your roadmap for where you want to be putting money. And parenthetically, heading that list in terms of favorable returns to that period was multifamily. It's not a coincidence.
So where do you see the U.S. currency going? How is that going to affect the economy going forward? If we keep printing, are we going to debase it, or is just the rest of the world weaker than we are, and we're still the safer haven, I guess? Yeah,
I think you're right, Gino. We win we win the ugly dog contest, right?
That's the worst.
Yeah, we're not pretty, but there are worse out there. I decry the position of the United States in terms of its indebtedness and how puffed up the economy is from stimulus. But I mean, we're beginners in this game compared to the Chinese market. I mean, that's an economy much more likely to tumble or stumble than we are because of its finances and because of the trends that we see today, like nationalism.
And the lack of transparency. We don't always know what's going on there. So I think that plays a huge part of it. A lot of falsifying. So, yeah.
Yeah. I got a kick out of the Chinese offering to help President-elect Biden with the COVID thing. No, guys, you've already done enough. Thank you very much. Much appreciated.
We're good. Thank you, though. We're good.
You led the next question. I was thinking about it.
I'm sorry, it's cracking me up.
How do you see this election affecting? I mean, does it change any of your outlooks if Biden does get elected and does get in? Do you see anything?
Buy tech stocks. Sorry, I'm sorry.
By green stocks, I guess. First of all, Biden has been elected. It's just a question of
Getting certified,
becoming official, but the transition team is in place and GSA is funding the transition. So that's pretty much a white flag being thrown about by the Trump administration. For us, the real game here is what's Georgia going to decide about their two senators. If we can have a red Senate, then the blue president and the blue Congress are largely negated. So we'll have what we call unalignment. And that decreases the chance of a significant tax change, not all tax changes, but a significant one. And that means for at least 2 years, we likely dodge the bullet in terms of what we have to maneuver around.
I kind of think the bulk of the country is open for that, a divided government right now. I really do. Like, that's just me, but we'll see.
Yeah, the bulk of the country is, yeah. In fact, I've heard criticisms that made sense to me that instead of fighting a losing presidential battle, it would have been better if the Republicans just put everything they had behind the Republican senator races in Georgia just to lock those up, The Democrats sometimes are smarter than the Republicans when it comes to campaigning. Anyways, so for 2 years, we don't have to worry about that. The biggest thing about the Biden tax plan that bothered me wasn't the increase in corporate taxes, because that would simply take us back by and large to where we were in terms of the top marginal tax rate and the combined tax rate. It was the lack of a step up in basis. That's a little nugget that turns into a real big problem in the shoe of any horse, right? And most people who aren't savvy about passing on their investments, maybe not caring, but that's a big game changer. So there are some ominous aspects to the tax changes, but you know what? And we tell our clients this all the time. It's not like we haven't seen it before. We haven't seen the change before. It happens. We know how to deal with it. All right. So you can't freeze. You can't say, I'm not going to do anything until I know what that's going to be. You just be smart about it, but you still got to plan. You still got to grow. You still got to have to increase your wealth. You just got to do it a little bit differently. That's all.
Do you have any fear of a 1031 exchange going by the wayside, or anything to do with cost segregation? Do you see anything changing with those two big tax issues?
Not in the next 2 years. Okay. I mean, President-elect Biden has talked negatively about those issues, but nothing's going to change there in the next 2 years.
Okay. I've heard that one of the reasons why multifamily is been really hot is because it's like the gold. Someone actually told me it's like owning gold with a yield. I mean, do you sort of agree with that point? Because you're buying gold, you're buying a metal, it's just not producing anything. But multifamily, on the other aspect of, hey, you're buying a property that's actually an asset that's actually cash flowing, and people are looking at it as a stable way to actually try to preserve capital. Would you look at it from that perspective also?
The stable way, in the way you used it, really highlights your approach toward cryptocurrency as a store of value.
I like that.
Yes. I'd rather own the real estate than the gold, because real estate I can own it, and because of the cash flow and the long-term cap app, I can just forget about it. Gold I can't afford to forget about because that has too many fluctuations along the way that I may want to take advantage of. But I'm more of a long-term buy hold when it comes to real estate than I ever would be for gold.
Love that. Last question before we get to the personal questions. What's your best tip for the listeners in investing when they get into the investing world? Because we have a lot of young listeners out here. What should they really start doing?
Really, they're tied, but I break it down to two different things. They need to understand that there are what I call Drucker moments in the economy and in the investing field. Okay, and what I mean by that is Drucker advocated every business periodically reassess not only why am I in business, but should I be in this business? Has the environment changed, circumstances changed so much that I really should be pivoting in a different direction. So I call that a Drucker moment. Okay. And the other thing is the young ones need to know that money will flow from where it is to where it isn't. That's where the money is made, is in the flow.
Mm-hmm.
And they need to see those Drucker moments, and they need to understand that the money is actually made when it flows, and it is going to flow from high pressure to low pressure or vice versa. You get that, you'll do better than most people.
Let that money flow, baby. Let's take a quick time out to hear from our sponsor.
Are you looking for ways to improve your life?
Here at Jake and Gino, our mission is to empower students through financial education and the vehicle of multifamily investing.
Yes, Jake. We agree that a person with financial intelligence can change the world for the better.
We've created our proprietary 3-step framework, buy right, manage right, and finance right, that we teach to our community. This framework, along with education, our one-on-one mentorship, on-site boot camps, and the amazing community, has propelled our students to massive success.
We've all been there. We've had so many students that have been able to shift their mindset, overcome limiting beliefs, and set a clear path to achieve their goals. Whether you're currently fixing and flipping, wholesaling, or buying single-family rentals, and you know that multifamily investing is the right vehicle for you, I encourage you to visit jakeandgino.com/apply to schedule your complimentary consultation with our team. And I want to let you know this isn't a high-pressure sales call. It's really just a discovery call to get to know each other better and see if we're a good fit for working together. And if for any reason we're not a good fit, our team has tons of resources we will share with you to help you along your journey.
If you're ready to stop spinning your wheels, go to jakeandgino.com/apply and schedule your call now. All right, we are back. Tell me your top 3 markets for multifamily going into 2021.
Well, let's see. You told me to say Knoxville.
No, that's where I love this show, but it screws me because all I do is put more attention on the stuff that I want to buy. So let's pass on that one.
That was just fun. Dallas is one. Either Knoxville or Nashville would be another one for me. Still, also a very great market. You said just the top 3, so I guess from there I'd go to Salt Lake City.
Mm-hmm.
I always kind of lump like a Dallas, Jacksonville, and Nashville. There's a lot of growth there in all 3 of those spots. So we're talking multifamily earlier. You're saying the inflation hasn't hit yet for 2 or 3 years. The other component to that is when the inflation hits, you're saying rates are going to rise. So speak to that, the power of that a little bit, because essentially what we could do right now is lock in sub 3.5%, maybe around 3% on an interest rate, get in before we realize the inflation rise, if we can buy on somewhat of an actual number right now. So I think there's a lot of power in that. Is that essentially where you see the opportunity?
Oh, absolutely, yes.
So locking in long term, yeah.
Lock it in long term and plan on holding it until around 2029, and then at around 2029 we may very well have another Drucker moment, and that could be one of the unintended consequences of all the stimulus that we've just experienced, both fiscal and monetary.
Mm-hmm.
Elaborate on that, please.
I thought are we in the short answer part of it, or are we in the long answer part of it?
We're in the we got to get educated answers section here.
All right. The size of the fiscal stimulus is just awe-inspiring, and it's created this acceleration in the indebtedness of the United States, right? We've soared up to 135.6% of our GDP. That's above where we were in World War II. The question that has to be asked, how big can that number get? And our answer is, it's not a question of how big that number can get before it becomes a problem. It's when does the rest of the world decide we're no longer credit worthy?
Mm-hmm.
Yep.
Right. That's the issue. So people are looking at the size, they're looking at the wrong thing. They should be looking at the sentiment outside of the United States. And the way we're doing that is by measuring US bond yields, the 90-day, 10-year, and 30-year, against all of our major trading partners. And we're looking for variations of norm. And if those variations start saying that we're starting to pay a little bit more than we historically have relative to our trading partners. So that takes inflation out of the equation, generally speaking. That'll tell us that the world's getting a little bit itchy about how much debt we are in. And that means that we could be looking at a paradigm change. Right now, the yield curve is pleasantly positive, and it's showing us that the bond market has the utmost faith in the United States still. And by the way, it's also telling anybody who cares to look at it, the bond market is saying the world looks good. The world is going to be going up in 2021 and beyond. That's exactly what the bond market is saying. And in my 40 years of doing this, I've learned you don't fight the Federal Reserve and you don't fight the bond market, because you will lose every time you fight those two. Okay, so you go with those trends, and that's exactly what they're saying right now. But think of the moral hazard that's been created here. We have politicians who, both monetary and fiscal, say we can apply all this stimulus and the world doesn't care and there's no inflation. So we learned that maybe modern monetary theory is correct. MMT, magic money tree, as it's sometimes called, right? Because nothing's happened, nothing bad has happened for 2 years now.
Yeah.
So maybe next time things don't have to get really, really bad before they say, well, it worked before, nothing bad happened. It creates this tremendous moral hazard, as we call it in economics.
Sense of security, yeah.
And think of the young people, all right? The millennials who said,
forgive my student debt, just give me some money. We don't need to worry about it.
Bail us out, bail us out. We want more. And somebody is going to accommodate, we want more. That will happen. And that's when MMT becomes a reality, and history is very, very clear. MMT will lead to ruin. And people are going to tell you, well, it'll be different this time. I don't know that there are any more heinous words in the English language than this time it will be different. It is not different. It just smells, looks, tastes maybe a little different, but the broad brush implications aren't any different.
Keep propping it up, right? So critique my strategy here. This is how I don't own stocks, I don't own bonds, I just own real estate, and basically I keep a cash baseline, and then when I find a deal, everything above that I plow into multifamily investments, and then I rinse and repeat, and I hold the investments. How does that fare up? If what you're saying, we go down that road, how does that look long term to you? Because essentially, I don't want cash. I just want assets that produce cash, because wherever the cash goes, hopefully I ride with the flow, right?
Okay. On the other side of the Drucker moment, there could very well be a period of deflation. So your asset values will be going down. So you need to take that into consideration. If you're thinking, well, I'm going to hold on to these because I still have positive cash flow. First, you don't want to be in the very expensive multifamily space, because during the distress period that we see in the 2030s, that you may find a higher vacancy rate than you're comfortable with. And you have to measure that potentiality against declining valuation of your asset for 3-4 years in a row. So that before that happens, before the Drucker moment, and again, you can't time the market, you may say, this has been a great ride. I don't want to own this in a potentially bad economic deflationary environment. So I will take cash for a couple of years, or I'll talk you into taking that cash, Jake, and putting it into Canadian government bonds, Swiss government bonds, and Australian government bonds. Interest rates, remember, are going to be high by then because of the inflation, right? So you're going to be living high off the hog while this property is going down in value. You're going to have this interest current coupon income, right, off these bonds. And then they're going to call those bonds probably around 2036 or 37 because of the high interest rate associated with those bonds. It'll be called at a premium, so you'll have a capital gain besides living very well. And you're going to have this influx of cash. Now you're going to look around, you're going to say, time to buy some more real estate. It'll be at a deflated value. So that's when that's your ultimate rinse repeat cycle.
I keep telling Jake whole life insurance. He doesn't want to listen to me, but I keep telling him.
No, I'm listening. I'm listening. I'm not acting. Okay.
Yeah, I don't blame you there. But,
So Gino, mark it on the calendar. 2028. We got to give Brian a call and prepare for this. So that's the January 1st, 2028.
Maybe a steak dinner too, if you don't mind. But,
Hey, I love. We're gonna go down the water. Ruth Chris. We're gonna get a nice cowboy ribeye, maybe a little glass of vino. We're gonna have a nice time, and we're gonna prepare for 2029. So January 1st, 2028. We got this. So
there you go.
all right, we're gonna get to wrapping this up here. Any book recommendations? We love to educate ourselves and share knowledge. Anything that you've read that you want to recommend to the listeners?
I'm an avid reader, so it's hard to pick one book. But for people who are in the business of owning real estate or any business at all, a book I strongly recommend is called Traction by Gino Wickman.
Yep. Love that one.
It is very helpful. And for anybody who really wants to understand America today and tomorrow, I recommend The American Journey by Colin Powell.
Cool. Love that. Nice little bit of diversity right there. Any tips for people from a personal finance perspective going into 2021? It could be anything, anything that you're seeing. I say going into 2021, I recommend, most people to take a look at this.
Yeah. Take a look at whether you have the right real estate stock balance. I bet most people are overexposed to the bond market because for 40 years, the credo has been stocks, bonds, other. I mean, Jake, you're very much the exception to the rule, right? Which is probably why you have that beautiful mantle in back of you. People probably
nice
have
marble back there.
People have way too much of their investable assets tied up in bonds, as far as I'm concerned. Particularly if you understand the threat of higher interest rates, why would you want to hold on to bonds? Because they're going to go down in value, right? Mm-hmm. I think you should be maintaining your weight in stocks. You can't afford to get out of this market at this time. And really think about overweighting over the course of 2021 in the other asset classes like real estate, like gold, other commodities. That's really should be the focus of your study going through 2021.
Awesome. All right. What's the best way for folks to get a hold of you, to start the conversation, and take advantage of all this great knowledge that you have?
Well, email me, I guess. It's terribly old-fashioned, but it's Brian, BRIAN, at ITR Economics.com. ITR stands for Institute for Trend Research, or I Talk in Riddles. It's all up to you guys.
Gino, this has been great. Really, really enjoyed this one. You want to wrap this up for us?
I guess Brian was a reformed accountant who went into economics, enjoyed it, lives in Naples, Florida, up in New Hampshire right now. He's looking at it from a macro level. I think the whole economy of what's going on. I think he's a little bit more bullish than you and I were, Jake, going forward. And all the reasons that he laid out make a lot of sense going forward. I was afraid of the stimulus, but it seems like that MMT, that magic money, is going to be happening in the future, sometime in the future. So don't listen to what all the prognosticators are saying. Do your own research. Start looking to all of the different asset classes, sans cryptocurrency, and just really diversify yourself and look into real estate, look into alternative investments. And we live in a great country, and I think we're the ugly, like Brian said, maybe we're the ugly dog, but we're the best looking ugly dog in the world, and I think we're going to continue to be that way. So I just want to thank Brian for being on, sharing time with us on the call, and just educating our listeners.
Can I share one more thought, guys?
Oh, we're here all day.
Most people don't realize, that the United States is the single largest economy on the planet. I mean, at least China is a relatively distant second compared to where we are. And they furthermore don't realize that 100 years from now, we're still going to be the world's #1 economy. Okay, when you look at demographics, we have the rule of law, you look at our natural resources available to us, and we are capitalists still. No one's going to touch us. All right, which makes me excited for my grandkids and my great grandkids. The future, bring it on. Bring it on, man.
Hell
We got
yes.
this.
It's about time someone said something damn positive about this shit.
Well,
Um,
Jake,
and-
not to cut you off, but real quick,
No.
I think that's the engine of our economy is we have freedom of thought and freedom of expression, and we're creative. That's what capitalists are. We don't copy, we don't infringe and copy trademarks and copy patents. We actually have people who want to come here
lead.
and
Yes.
create in technology. That's the driving force. We're going to be the ones who create the solutions to the future. We're not going to be copying the solutions, and that's the whole term with capitalism. That's what it's all about.
And that's where the money flows, baby.
That's what I'm saying. People don't get it. I mean, like you can copy all you want and rip off and duplicate, but at the end of the day, if you can't,
You're going to be
yourself,
a generic loser.
You're
Yep.
done, bro. So,
Hey,
wow.
Gino, there's going to be a roulette table at the Christmas party this year. Just, if you want to keep playing with those cryptos, man. Just saying. Brian, this was awesome. Thank you so much for your time. I hope you have a great rest of your day.
Thanks,
My
Brian.
pleasure, gentlemen. Thank you.